right, folks, thanks for coming. We're going to get started. My name is Rob. I organize Idea to IPO. We've been holding events in Silicon Valley and San Francisco for many years. If you go to our website, idea.ipo.com, you can check out all the events that we have on our calendar and all the details for those upcoming events. We launched officially on February 1st, 2010. At that time, we had no members and no events on our calendar. At this stage, we have over 60,000 members among all our meetup groups in the Bay Area. We've completed over 1,890 events. We're the most active, most prolific startup event organization in Silicon Valley, bar none. Thank you. Anyway, you guys didn't get the memo, but that's okay. Our mission is to promote entrepreneurship, support entrepreneurs, build community, and provide value in the Silicon Valley startup ecosystem. So we provide content that's practical, actionable, and relevant, and we believe in building community. And we have many partners that help us do what we do: law firms, venture capital firms, angel investor groups, incubators, accelerators, colleges, universities, lots of players in Silicon Valley. Tonight, we're grateful to K&L Gates for hosting us at this beautiful venue, providing us with this beautiful view, and providing us with the awesome buffet. Was that an awesome buffet? Yeah. Was that an awesome view? Yeah. Okay. Well, let's hear it for K&L Gates. Though our local mission is to support entrepreneurs in Silicon Valley, our global mission is to democratize entrepreneurship and innovation all around the world. So to that end, we have a robust YouTube channel, youtube.com/idea-to-IPO. Check it out. We have tons of videos. We've documented and archived many of our events. We have content that is reachable anywhere in the world, whether you're in San Francisco, Palo Alto, Moscow, or Timbuktu. Our partner in this endeavor is Tim Jeggers of Jeggers Films. So let's hear it for Tim.
Thank you, everybody. Thanks for coming. So I am Tim. I do the video for a lot of Rob's events from everywhere from San Jose to here. I've been doing video production for about 10 years. I do corporate info, interviews, all kinds of stuff. If you have any questions about that or where you can find this video afterwards, feel free to ask me for my card, and you can shoot me an email, and then I'll get you the info where the link will be and anything else that you might want to know. And other than that, when we get to the question segment, we want to hold them till the end of their discussion. And then I have a microphone here that's super important for the audio and the video. So when you have questions, if you could line up at the podium and then ask here, and then I would appreciate that. But, you know, you guys are all grown ups. I'll let you do your own thing. And I'll pass it back to Rob. Thanks, guys.
So here's the schedule for the rest of the evening. We'll get started with our conversation. Audience members, hold your questions until that conversation's over, and when it's time, just kindly come up here, use the microphone so that we can record it for our video. As a courtesy to our hosts, we're going to end the formal program at 8:30 p.m. That's our sharp deadline for the formal program. You can hang around, network. We'd like to leave the building by 9 p.m. So without further ado, I'm going to pass it off to our host and moderator. He's one of the top corporate attorneys in Silicon Valley, and he's a partner here at this firm. So let's hear it for Stan Lewandowski.
Good evening, everyone, and thank you so much for coming. It is my pleasure to have you, and I'm sure that we'll all benefit from the great discussion that we'll have and the insights into the Silicon Valley ecosystem and how things are done in this part of the world with our awesome guests. So it is my great honor and privilege to present you with SC Moatti. To me, she's an icon. Honestly, looking at her bio, what she has achieved, and I told her this personally, I'm extremely impressed. I wish I spent my last decade doing great things as she has done them and achieved maybe 10% of that. So I read so much, and I will say the following. First and foremost, she's an incredible entrepreneur. Probably each of you has aspirations to become a successful startup builder and successfully exit your companies. She can definitely share some thoughts on how to get there with proper set of ingredients. She's a fabulous business leader, tech visionary, best-selling author. I just finished reading a book that I will tell you briefly about. She spent some time with the biggest social network company as an executive, and there are two outstanding items that are based on the feedback I got through LinkedIn, the two most important things for this audience. She's a founder and manager of Products That Count, and she founded and manages a fund called Mighty.Capital. So please join me in welcoming SC Moatti. Now, I mentioned something about the book. So if you've come to this place today without an idea what book I had in mind, the book is titled Mobilized, an Insider's Guide to the Business and Future of Connected Technology. And that book will teach you how to make a mobile product a very successful venture. So that's one. Now, based on the feedback that I've received from my online survey, and several of you are in the audience who I recognize who responded to my announcement and provided some questions in advance you wanted me to ask them, so I will ask them today. And I know based on the faces that we have several founders of already good companies in the audience and people who work for bigger companies but are contemplating becoming founders in the foreseeable future. And that event is for you to learn how to set up your next steps in order to become a successful venture. So we'll focus today on items related to early stage financing. And I will have some questions that are general in scope, and some will cover topics that people specifically ask me to cover. And then when we get to Q&A with the audience, you will have chance to ask for 30, maybe a little bit more minutes about the issues that are on your mind that relate to the topics we discuss, and also things in general that may not necessarily relate to financing, but other things that SC has been working on for many, many years and has great experience to share with you. So without any further ado, I will start off not talking about Mighty.Capital and Products That Count. That will come a little bit later for everybody to know where we are going. I will start with a request for our guest of honor to describe a little bit the Silicon Valley fundraising environment and share your thoughts on whether or not this environment has changed in the last few years, and if so, how.
So thank you for having me. That's probably the most glowing introduction I've ever had, so I have to live with the expectation. But it's great to be here. I hope this is going to be a helpful session. So the fundraising environment, has it changed? I think yes, greatly so. I will say there are things that haven't changed, and then things that have dramatically changed. Some key trends. One is it's much easier to start a business than it was 10 years ago. It's much cheaper. So there's an expectation when you come and you want to raise money that you'll be a lot further along the way than 10 years ago. 10 years ago, you could still come and have a PowerPoint and a rough prototype and say, well, to build that prototype or to host that prototype on various server, the cloud was just beginning at the time. I need some money, and now the expectation is you'll have a working service, you'll have users that will be engaged, and then you'll come for fundraising. So the expectation is much higher. I think also that the environment for entrepreneurs is a lot more sophisticated. 10 years ago, there weren't that many events like this. In fact, Rob's organization is a pioneer in doing that, and it's not yet 10 years old. So entrepreneurs were a lot more ignorant in a way, which means that there wasn't an understanding necessarily of the fundraising process, of the expectation for the need for milestones and metrics and growth. Now entrepreneurs have networking events like this one, they have online educational channels, they have accelerators, they have really gotten organized. So that's another big difference. If I look at sort of moving towards investors, I see some trends as well. One trend which I'm personally concerned about is that the smaller investors are quite ignorant. And that's a problem because when you're an entrepreneur and you're trying to raise money, one of my huge pet peeves is you want to get smart money. You want to get money that's not just the green dollars, but you want to get money that's going to give you wisdom, advice, contact, introduction. And I'll share an example in a minute of why this is important. But you know, unlike the entrepreneurial ecosystem, which has gotten organized and more sophisticated, the early stage entrepreneurial ecosystem is still quite ignorant and not sophisticated and not understanding what it takes to be a successful investor. There's sort of this general assumption that says, I've been a successful executive, I've made a little bit of money, therefore I'm going to be a successful investor, which is to me the same thing as saying, I've been a great engineer, therefore I'm going to be a great salesperson. You know, comparing apples to oranges doesn't have anything to do with it. So why it's important, I'll give you an example. About 6 months ago, I get an entrepreneur to come and pitch his company to Mighty.Capital. And I've known this entrepreneur, and he's, you know, he has an interesting business. He has some nice traction. So we've been following him. He's been on our watch list. And he comes in for a meeting in person and goes through his presentation for 20 minutes. And then at the end, he says, well, but I've got something really important to share, 20 minutes in the presentation, which is, M&A discussions. What the hell are you doing here? Go sell that company, go be a very successful entrepreneur, and then start your next company and come back, you know, to raise money. Why isn't that happening? Why is this guy still trying to get money? Because his investors are not sophisticated or smart investors. If you have a sophisticated investor and you're in a situation like this, they will be breathing down your neck. Go identify more buyers for this company. Go fetch more offers, set deadlines, set up a proper, you know, exit process for your company. What are we going to do to maximize the value of that company? How are we going to return maximum value to shareholders? You will be hearing all about that. And you want to be hearing all about that because an investor, that's their job to do that for you. And that's how you as an entrepreneur, you become wealthy, you know, start your next company. That's how you get into the mode of being a serial entrepreneur, which most entrepreneurs are serial entrepreneurs. So if on the other hand you have somebody who just gave you money, doesn't understand how Silicon Valley works, doesn't understand how they maximize the value of the company for you and for them, they'll be very passive. They'll be, oh, great, well, keep us posted. And that's really not a good investor. So it's just an example to share, first of all, why you want smart money, because I think that's really important, but also how, you know, investors today at an early stage are not as sophisticated as they need to be to make you more successful. And then another trend that I see that I think has changed is that larger funds are raising much, much bigger amounts of money and therefore need to invest much, much larger amounts of money in companies. And that's, you know, good and bad. A lot of entrepreneurs measure their success by how much money they're able to raise. That's not exactly how you measure success. If you ask me, you measure success by your exit, because that's the end game. But regardless, like if you're thinking, oh, I'm going to raise this huge amount of money, I'm going to raise like 10, 50 million, $100 million, what are you going to do with it? And the challenge is, if you don't know what you're going to do with just say $10 million, like don't take $10 million, because that $10 million comes at a price that's more expensive than you should be willing to pay. Let me explain that. A $10 million investment on a company where you don't know how to spend it means it's probably more money than you need. If you take more money than you need, then you're giving away a lot of control. So in return, your investors really own you. And when an investor writes a $10 million check, they expect $100 million or more exit. Is your company worth $100 million? Maybe, most likely not. And I know that's not the answer you want to hear, but about 97, or precisely 97% of exits, that's from last year from a investment bank that's local, 97 of exits, M&A, are under $100 million. So if you think you're in that 3%, okay, you can take that much money. But if not, and you take that money, what's going to happen is that investor will never let you exit for less than $100 million. And when comes the point where they're going to see like, okay, so there's not going to be a $100 million exit, there's going to be maybe a $50 million exit. Well, guess what? They're going to get all of that $50 million and you're going to get nothing. And I know a couple of people like this who build companies that are worth $50 million and got nothing out of it, and you don't want to know them. They're bitter, they're angry, they're unhappy. So that's another, I think trend that I see. Sorry for the very long answer, but don't take more money than you need, because the first person to get, screwed is you.
No, thank you for that. There is a danger in what you said. Danger to your fund. You said only work with smart investors, and that means I see a lot of people who are probably looking at you saying, I'm coming your way very, very soon. And I cannot emphasize this more. Like as he said, I work with many companies that accept good money, but there are also some that suffer and for different reasons cannot attract, for multiple reasons, smarter investor base, and they take money that's passive investment with not too much strategic advice and leads that you otherwise get, and that's what leads to problems later. So don't think that money is equal. It's definitely not. Some people ask me on this private channel if I could get your perspective on something extremely easy, but they wanted to understand how you divide different financing stages on this one line where you start your company, you are incubating your business, how much money you need for that, how much time it should take you, then you go to the next level, you are pre-seed, how much money on average you should take for that, and again, no company is the same as another one. Then you go to seed stage, Series A, and we can stop at A because that's pretty much this audience, I think, is mostly interested in 0 to Series A. The rest is kind of easier topic to discuss. It's a different discussion. The money comes faster then than now. If you could share your thoughts and experience on that, that would be awesome.
Mm-hmm, mm-hmm. Yeah, so what is happening is that this 0 to Series A is being stretched in a lot of different steps, and it's a very crowded environment for investors, and so they're trying to find their niche and position themselves in ways that aren't necessarily favorable to you. So here's a scenario. I'll describe a scenario that I think is not desirable, and then I'll explain why it's not desirable, and after that, like you say, every situation is unique, so it's your job to find a way to kind of leapfrog through like the many steps that I'm going to outline, and the problem is with too many steps. So let's say you're just starting your company, you have an idea. You're going to go to an incubator. An incubator is, you're going to take your idea, you're going to say, oh, we're going to help you build a prototype. And when you graduate from that incubator, you'll have a prototype. And we'll only take, say, 7 to 10% of your company. And at the time, your company is worth kind of nothing, so you're like, whatever, I have nothing to lose, boom, 7%. Once you have your prototype, you have to go to an accelerator. And the accelerator is going to tell you, hey, we're going to help you get from your prototype to a few customers so we show some traction. And at the end, we'll do a demo day, and you'll see you'll raise a seed round in no time. Right? So the accelerator is going to help you get there, and they'll say, oh, and by the way, we only take 7 to 10% of your company. So they're 15 to 20%. And at that stage, you're saying, okay, I'm going to raise a seed round, but most of the time it's a little bit early for a seed round. So you have to go to a pre-seed investor. It's going to say, hey, I'm going to get you from like those 2, 3, 5 pilots to like 10 paying customers. And I'm only going to take like 10 to 15% of your company. So now we're at like 30 or so percent, right? You're still not at the seed stage, right? So then you have some revenue, some traction. You're ready to raise a seed round, which is traditionally getting you to your Series A. Except that, it's harder and harder to go from that seed to Series A. So you're going to raise a seed round who's going to say, I'm going to get you from like 10 customers to about like maybe 30 and a repeatable sales process. And I'll take about 15-20% of your company. So we're from 30 to 35 plus 15, where you're about to lose control of your company. You still haven't raised your Series A. And except for some rare companies, then you sort of have to raise another post-seed or node to A or whatever that's called, depending on the segment, which is going to take another maybe 10 or so % of the company, which you've lost control. And comes your Series A investor, and at that point you need to allocate about 20% of your company to the Series A investor, plus 20% of your company to an option or employee incentive pool. And at that point, there's really nothing left for you because you've kind of given everything away. And at that point, I won't invest in a company like this because there's nothing in it for you, right? So that scenario, which is sort of dragging you along and saying, oh, I'll take you by the hand, I'll do it all for you, is really what you don't want to go through. Because if you think about, I'm going to raise a Series A, that's not even where you really want to lose control of your company. Because after that, there's the Series B investor who's going to get another 20% of your company, and so on and so forth. So the reason I share that is that I see that happen more and more with companies. I see them come to Series A where they only have maybe 30% left of the company. Everybody else has taken, everything in the company. And those companies, they are in really difficult situations because they could be great companies, but they cannot raise money. So what they do is they'll go to their previous investors and they'll say, hey, you thought you got 10%. Well, actually, we're going to make that 2%. Guess how happy those investors are, right? And then they go to the founders and say, oh, you thought you had 30% left. Well, actually, we need to make room for everyone, so you only have 5%. And yes, it's great to have 5% of a big pie, but when you pour your entire life into a company and you're at Series A stage and you end up with like 5-10%, you completely lose your motivation, and you're another one of those, disappointed, angry entrepreneur. So, it's frustrating. Your baby is being taken away from you, right? So it's not fun. So anyways, so that scenario, I know it's like super negative. I'm sorry, but I'm saying like don't do that, right? Find really scrappy ways, like skip the incubator, do the accelerator really kind of when you're already ahead of the game. So you're going to be the rising star, the amazing portfolio company that's graduating from that accelerator, and you're going to raise enough money at that point to get you all the way to Series A. And if you do that and you're really scrappy and you don't get greedy and you find ways to make money quickly, you're going to have a successful company that's going to be not just a successful business, but also a successful exit for you that's going to allow you to start another company and be that amazing serial entrepreneur.
That's a great description. I hope you are not discouraged to build your startup. Just build it wisely,
Sorry,
right?
Don't be discouraged.
Just
awesome.
have good people on your team, and they will help you structure things properly, right? Otherwise, there are cases like this, and from time to time I have something similar. We have one founder, the main founder, and post Series A, this founder, based on pro forma, looks like will have less than 15%. That's already a red sign that investors don't like. The motivation has to be there, so sometimes there will be what we call option refresh to bring the founder a little bit higher, because otherwise the investors are now possibly looking at someone who will not perform as expected, right? That's awesome. This kind of brings me to another thing. How would you describe your optimal startup's life cycle? I know that there are some exits in less than 2 years, that's great. But taking the average case scenario, if you are looking at a startup and possibly you would want to invest at some point, and we'll talk about this more, what life cycle you would like to see?
Yeah, so a great scenario is a scenario where you start to generate revenue quite early. So for example, things we like to hear at an early stage is we only do paid pilots. And why we're saying that is because if somebody, like, nobody wants to disappoint you as an entrepreneur. So if you come to them and you say, do you like my product? Nobody will say, no, I don't like your product. Everybody say, yeah, I love it. Question is, are you willing to pay for this? And that's when you actually have a real discussion about value creation. So the first advice is avoid free pilots at all costs. And so we like to see companies that come to us say, I have like half a dozen paid pilots, and it's okay to do them at cost if you must. Do them for a little profit is even better. So that's one thing we like to see. The other thing we like to see is, so that's on a sort of a business traction, right? The other thing we like to see is a great team. So very often we'll, we won't write a check in the first meeting, so we'll get an opportunity to meet with teams multiple times, and we want to see a great team dynamic. And what I mean specifically by a great team dynamic is three things. One is complementary skill set. So we want to see a team with diversity of skills. Two is compatible communication style. We want to understand that when there's going to be conflict, it's not a question of if, it's when there's going to be a positive outcome to this. And then the third thing is we want to see a similar appetite for risk. And that's probably, as an investor, the most important thing. And I can explain why. Let's say, a few years after your paid pilot, you get an opportunity to sell your company. And I'm going to say, like, I'm going to make you an offer to buy your company for $15 million. And I can tell, like, somebody over there is like, $15 million? Like, are you insulting me? I'm going IPO or nothing, right? And then I saw somebody else over there, oh, $15 million, that's okay. That's my first company. I'll take that, right? Now, if you two are co-founders, and it's nothing personal, it's just, for example, if you two are co-founders, you're going to have a conflict, right? Like, I want to exit at $15 million because I can get, 3 Ferraris and I can start my next company, and like nothing but an IPO, that's a conflict in your risk profile. So you want to have the same appetite for risk. So we look at the team, we look at the sort of your business acumen, your appetite for your traction and business. We look at the market opportunity. We want to understand if there's some defensibility in the market, and how you position yourself there. So playing defense and offense. And then the last thing we look at is the fit with Mighty.Capital. So that's another really important criteria for us, and I'll explain why. You can get money from anywhere, right? And if you have a great deal, you'll have many opportunities to take any kind of money. And, really for us as investors, we will want to be in a deal where our money is, looking a different color than green, like is adding a lot more value to you than just the money, because if we have that ability to provide that extra value, then you'll want us on your deal and we'll add value and it will be additive. So we look at that fit. The value that we bring as an investor is that we give you access to products that count, to that network, which is one of the largest networks of early adopters and product managers in the world. And so if you have an interest in either selling to a product manager or a marketing manager or hiring at scale some product manager or marketing manager, then we can provide an immense pool, like hundreds of thousands of people that you can sell to or hire from. Then there's a lot of value. But if you're trying to sell to doctors, we don't have that. I mean, we have some expertise and some investments, but we may or may not be the best choice for you. Right? So that's an important aspect we look at.
No, thank you so much. That just answered two questions that I had on my list. So whoever was listening or will be listening, those questions pertain to the optimal founder team. You just addressed that. And another question was, when, if at all, should a startup have a business plan? And if that business plan is required, what characteristics should it really reflect?
Yes. So on the founding team, just one more thing. If you go to our website, Mighty.Capital, you'll find there's a post, what makes a great co-founder or something like that. And in that post, you'll see that highlight of the three characteristics we look for. And you'll also see a test, which is something that if you're currently evaluating various co-founders, you can take, you take it separately, discuss it. What's interesting about the test, it's meant to be funny, I don't know if it is, but it's like 10 questions. And the questions are meant to highlight those three different characteristics. And then what's important, I think, if you're evaluating a co-founder is to look at the answers with your co-founder. Now, on what should go in a business plan, so we invest later stage than business plan stage. So if you're sort of at that idea stage, it's always good to put together a business plan. I will say if you're at that super early stage, what I recommend, so once you have identified, say, 2 or 3 possible co-founders, you're sort of in your short list, what you could do is have brainstormings around various business ideas. And having a systematic approach, by the way, is a good thing, right? A lot of people say, oh, I love that stuff, therefore I'm going to start a company. That can work, but a more systematic approach to I'm interviewing potential co-founders and I'm evaluating potential business ideas is more effective, in my opinion. So what you can do with your possible co-founders is have those brainstorming sessions where each of you brings, say, 5 ideas, and you pitch it to one another, and then your role is to try and, destroy the idea brought by the other. And whatever survives out of that, you'll bring, say, 10 opportunities, and maybe 2 or 3 will survive and say, oh, there's potential there. Then you can build some form of business plan around that. Now, we invest a little bit later stage, so what we look at in a company is the ability is a very simple story. And in fact, there's another post on our website that describes that. I think the post is called How to Craft a Killer Pitch Deck. And the story goes like this, and if you, slightly tweak the language, it will probably apply to your company as well. It goes like this. It's like, we are a unique team solving a big and hard problem with a sustainably differentiated solution. As a result, we have great traction, which we monetize fairly. And so our financials look very promising. But to get there, we need money. And this is how we plan to return that money and much more. And if you sort of go through those, 7 or 8 little sentences, first of all, it probably describes your business, right? It's very generic, but we are a unique team in this industry solving a big and hard problem, related to that, situation and so on. But it probably tells your story in 30 seconds. And every sort of piece of that story is one side of your deck. We are a unique team. What's unique about that team? Solving a big and hard problem with a sustainably differentiated solution like offense and defense. As a result, we have great traction. What's the pipeline of traction? Which we monetize fairly. Okay, how do you make money? Therefore, we have great financials, revenue and cost. But to get there, we need money and show the terms, right? What's the deal? And this is how we plan to exit, right? Return that money and much more. So if you just tell that story, one slide per sentence, to me that's an amazing pitch. That's a pitch that takes 5 minutes, and then our introductory meeting are 30 minutes. So if you pitch me in 5 minutes, then you have 25 minutes to drill me on how I'm going to add value to your company, as opposed to, we're just trying to get the story out.
That's a perfect advice. Really take it. So now I know that you guys invest in late stage companies. So that's in my book, that's pretty much Series A and later. But for people in the audience who are thinking about raising the first couple $100,000, based on your experience when you were the founder of your company after you left Nokia, if I recall correctly.
Mm-hmm. Yeah.
If you can share some experiences about how the process went for you, whether it was difficult, what was the most difficult during that time, and how you were able to overcome the obstacles in front of you before you secured enough financing to get to the next level.
Yeah. So I can tell you that was incredibly difficult. We got rejected by dozens of investors. And if I look back, like, I'm not sure I would have funded myself like back then. So I understand. So some of the things to overcome. First of all, you actually don't need to be rejected by dozens of investors. All you need is to go to 3 to 5 smart investors who know you a little bit, and if they tell you no, then you're wasting your time going to anybody further than that. So we made that mistake. We just thought, oh, they don't get it. We went to more and more and more. So that's the first thing. Second, really, I come from an engineering and product background, and so at the time, I really thought building something great, build it and they will come. And that's not true, especially in small companies. It was true, or it can be true in exceptional companies like Facebook or Nokia, but most companies, that's not how it works. And so understanding really follow the money is one of the best advice I've ever received. And an entrepreneur who comes to me and says, oh, I'm just building this cool stuff and I'm sure I'll figure out how to monetize is a red flag. You really want to follow the money. Frankly, some of the things that I thought that we did right at the time that I think were sort of scary to do. One is if you still have a job, quit your job. So in other words, nobody in their right mind will or should give you money if you're not, if you don't have enough skin in the game, right? If you don't have skin in the game, why would I give you some of my skin? So make that transition if you haven't, decided already. And then once you are in it, then you have to be committed, right? So you need to have at least 18 months worth of runway. And by 18 months worth of runway, I don't mean 18 months salary saved. I mean 18 months of living expenses. And it sounds a lot a lot easier than 18 months of salary, and it is. All you need is for 18 months to be able to pay your bills without having to worry. And I see some entrepreneurs come to me and they say, oh, I have 3 months worth of living expenses. Don't even try. You're going to basically waste 3 months of savings, because to start a company, there's nothing like an overnight success. You're going to try something, it's going to fail, you're going to have a co-founder who's going to bail, you're going to have an idea that's not going to pan out. It's going to take at least 18 months for you to get to a point where you can say, I think this thing has some legs. And how you do that, one of the best advice I got at the time is you have to, first of all, think about your living expenses only as opposed to salary. And living expenses tend to be really, really low. You pay rent, a little bit of food, it's not that much money. Second, if sometimes you say, okay, I'm going to extend my runway by doing a little bit of consulting, you have to think of your consulting as maximizing the dollar per hour so that your time is entirely dedicated to your venture, right? So if you're going to take an assignment, like, make it a high price, right? Like, okay, I'll do this thing for you because I have to live, but I'll charge you a high amount, because that basically maximizes the dollars on the consulting time and maximizes the time on the entrepreneurial time. So sort of dissociate how you make money from where you spend your time. So at that super early stage, those are some of the things that.
Would you mind expanding just a little bit? If someone has graduated from this treacherous place and now needs to raise, let's say, in my life, a good seed is still something between 1 and 4, sometimes 5. It's still called seed. Sometimes companies have 2 million in notes and then they convert all of that. How should they approach this additional piece, raising a few $1,000,000, but pre-Series A?
Yeah. So when you're at that stage, what has changed in the last 10 years is that accelerators are now the place where you really have a sort of a runway to raise that seed round. So 10 years ago things were different, but now I would say you want to be admitted in one of the top accelerators. So you spend that year and a half preparing and making sure that you have like the product, the traction, very early traction to basically apply to one of the top accelerators. And there's getting your company ready, and then there's sort of schmoozing your way and networking your way into an accelerator. And so that means trying to meet some of the mentors, researching, understanding the process, talking to some alumni, so that you understand the game that needs to be played to get into a prominent accelerator. Once you're in that accelerator, you want to maximize your chances of raising that money. You want to actually give it everything you can. You want to be the star in that accelerator, so that you'll get all the attention of the mentors, you'll get all the attention of the program, because they want you to be successful. You're gonna, your success is gonna be their success. And when you graduate, that will mean most likely that you'll be in a great position to raise that seed round. When you go and try to raise that seed round, I would say, raise enough money to get to your Series A, but don't be too greedy. And don't be too greedy is important, because we see a lot of companies at some, very kind of mediatized accelerator that have crazy high valuations. And that doesn't work to your advantage. You want a fair valuation. You don't want a low one, obviously. But if you get a too high of a valuation, then most likely down the road you're going to hit the correction. So for example, we see some companies who come to us and they have like some revenue, and they're asking for a valuation that's like 30 times the revenue. Well, do you know what the PE ratio of Facebook is? It's about 30. So if you think you have the next Facebook, okay, that's possible. But most likely you don't, right? Facebook is that 1 in a 10-year company. So don't come in with a ratio that's so outrageous, because your next round, there's going to be a correction. And the typical multiples are anywhere between 2 and 10 times your revenue, depending on the type of business you have. So if you go from 30, if you find somebody who will give you a 30x multiple, the next round is going to hurt really bad, because you'll go back to that, 2 to 10x multiple. So let's say just 10x. Guess what that's going to do to that investor and to you? Right? It's going to kind of compress everything. So when you raise a seed round, raise it at a fair valuation.
That's a very nice segue. You just said you will have at least an opportunity to discuss the valuation and other things. Now, one of my colleagues has asked whether or not she should understand the term sheet when the term sheet is presented to her, or whether she should just pass this on to CFO or somebody else to deal with it. It's all about understanding what you are getting into.
Okay, so this is the story. My husband races motorbikes, Ducatis, not just like any motorbikes. Like for those of you who don't know, I see, okay, you're with him.
That's a big knowledge.
So Ducati is like the Ferraris of motorbikes. So you go into the Ducati dealership and it's all nice and fancy and there's a little sticker with the price of the motorbike. Except, as you know, that's not the price that you pay when you get out of the dealership with the motorbike in your hand. You end up paying a lot more because you pay for the maintenance and you pay for the insurance and you pay for whatever, the tire change and whatever it is, right? So the list price of the motorbike is way lower than the total cost of ownership of the motorbike. Well, it's exactly the same with companies. The list price, the valuation, is a lot lower than the total cost of ownership. So if you don't want to understand everything between the list price and the total cost of ownership, that's up to you. Like some people will buy a motorbike and will say, what's the price? Okay, and what's my monthly payment? I'll just sign and I don't care. But if you're financially conservative and savvy and you want to be a smart entrepreneur and a smart buyer, you're going to try to understand, like, okay, so that's my monthly payment, but how much of that is the bike and how much of that is the rest, right? So the terms matter a lot when you purchase a motorbike. Well, they should matter a lot also when you sell some shares of your company.
No, excellent. Now, switching gears a little bit, and for many startups, those things are not as important as for others, but what are the key metrics startups should really fully understand and be able to explain to you in their sleep, at least the basic ones?
Well, so it really depends on the business. So let me think of a way to answer that. Okay, I have a way to answer that. So this is the way. This is a balance sheet. So on this side of the balance sheet is assets, and on this side of the balance sheet is liability and equity. And your investors and your ownership of the company is on this side, liability and equity, and the two add and they have to be the same, right? So far you're like, see, we know that. Okay. Yes, you do. So the bigger your equity, the bigger that asset column, and when you're a small company, that's revenue. It's not cash and account receivable. So you're going to make your investors happy and make yourself happy if this gets bigger, which means that the more revenue you make, right, the happier you and your investors will be. So then the question is like, okay, how do you describe your revenue? What are those key metrics? So revenue is volume times price, right? That's economics 101. Volume, depending on the business, there's like high or low velocity businesses. So I buy lots of stuff on Amazon. I don't really go to the Ducati dealership very often. I wish I would never go to the Ducati dealership. So there's kind of high velocity and low velocity, right, in those businesses. So really that means that equation is more like revenue is number of customers times number of transactions per customers, that velocity, times revenue per transaction. And that's how you explain your key metrics, right? Number of customers, that's your acquisition strategy. How am I going to go about getting more customers? Number of transactions per customer, that's your engagement strategy. How do I get people to come back for more? And then the revenue per transaction, that's your monetization strategy. How do I get high price for what I offer? So if you show this to your investors, to your employees, like if you use that sort of business equation as your company dashboard, I think that's a great way to think about your business. And so it's a little bit abstract. So if we take Airbnb, we're investors in Airbnb, and I try to do that business equation. So a customer at Airbnb is a guest, right? So number of guests, like how am I going to increase the number of guests? Then the number of transactions per customer is the number of stays per guest. So how am I going to get guests to come back more often? And then the revenue per transaction is the commission on each stay. So how do I kind of think about that? So the business equation for a business like Airbnb is number of guests, how do I maximize that, times number of stays per guest, how do I maximize that return rate engagement, and then times commission per stay.
Well, excellent response, and that's so true. Now, kudos to someone from São Paulo, Mario. When he watches this, he will have the answer straight from SC. For companies that are still in the process of migrating to the US with the intent to come, scale, and in the process raise Series A, what would be your best advice for those companies? Who should they bring with them? Who should stay overseas, and how should they really deal with so many things that probably some people in the audience can also help with, strategize on the cultural aspects and many things that they are fully unaware of that are waiting for them in Silicon Valley compared to where they come from.
So I get that question all the time, and what typically happens is an entrepreneur will say, hey, as soon as I secure the funding, I will move. To which I say, well, that sounds great. So once you've found somebody to pay for that relocation, contact me, and then we can talk about me investing, right? It's really a matter of skin in the game, right? Once you make that commitment to move here, then I can make that commitment to invest in you. So between now and then, the first thing they should do is they should find someone like you, actually, Stan, a lawyer, and a great lawyer to help them with that transition. That's critical. That's probably like your one of your very first move is find somebody who's going to help you from a legal perspective, make sure that the entity you create is one that people will want to invest in, where the IP will be, and so on and so forth. When you talk about relocation, like what does it mean? Like, is there transfer of ownership? Is there some implications related to tax? All sorts of stuff that you will know and are really important to clean up before you sort of think about getting local investors. So that would be the first thing. And then as far as like what part of your team should be there, if you're going to raise money here, you want to have a team there permanently with at least one or two executives. And so it can be any executive. We prefer when it's the CEO, of course, but if it's a head of sales or something like that, that's also a possibility. And then, saying I'm here but my kids are there, that's not being here. Really, when we're talking about relocation, it's like changing life, right? It's relocating. It's not sort of going back and forth and doing this for a while until you can go back. So it's a massive commitment, but it's it's also how you make your business successful.
Well, thank you so much. So before we get more into what Mighty.Capital does and its focus, etc., that's probably many people came to hear about that. I would like to hear from you about the most commonly made mistakes by startups during the fundraising process, whether it's the pitch-related set of mistakes or any other mistakes that you view as pretty much a set of mistakes derailing the process that you don't believe the startup team will be successful fundraising.
Yeah. So a few things. One is if you're working with investors who are actively investing, they actually want to invest money. So you don't need to pressure or to put some form of like FOMO, like fear of missing out mechanism, which we see some entrepreneurs do. Like that's actually a turnoff. Like if I come to you and I tell you like, give me your money tonight, right? you're gonna laugh, right? And the life cycle of your company is really long. So you want to have a relationship that's going to last like multiple years. So so the first thing is there's really no need when you work with active investors to try and sort of constrain the process. If you work with people who tell you they invest and they really in reality don't invest, then it's fine to shake them out with a different set of questions, like how many investments have you made recently, how many more investments are you planning to make this year. It's actually a more effective way to weave out the active from the inactive investors than to say, give me your answer tonight, because from a professional investor, putting that kind of pressure on will lead to a no, for sure. So that's the first thing, first mistake. Second mistake is once you get an investor interested, keep nurturing that relationship. Very few professional investors will write you a check very quickly. They'll want to, they'll want to draw a line as opposed to like 1 or 2 dots. So they'll want to meet with you one-on-one, then meet with you in a small group, then have a coaching session, then have maybe a larger meeting session, then they want to visit your office, and so on and so forth, right? They want to have like a set of interactions with you where they see you on a good day, they see you on a bad day, they see you in groups, alone, and so on and so forth, so that they get to know you. Letting that process happen doesn't mean that you let it happen, right? So you have to find the right balance between like, I'm going to, constrain the process and I'm going to let the process happen. You want to manage the process. And I think that's one of the most difficult things, but that's also the most effective.
Excellent. So now switching to Mighty.Capital, finally. Would you mind telling us a little bit about its focus and draw a picture of the most optimal company that you would like to see entering the door, and you would know very quickly that that's the company you would like to put $1 million or $2 million into?
Mm-hmm. Yes. So Mighty.Capital, we just finished raising our fund. It got raised very, very quickly. It got raised in a little over 6 months. Typically, to raise a venture capital fund, it takes 24 months. And we're oversubscribed by 30%. So we're very eager to write checks, very actively exploring, what is going to be our portfolio. What we invest in are companies that are building the third wave of, I call that connected innovation. It used to be called mobile, it used to be called digital, now it's connected innovation. Based on my book. So the first wave is put a phone in every hand. It's that Nokia era. The second wave is collect data about everything and everyone, the Facebook era. And now do something useful, which is disrupt the enterprise. So sales marketing focus from our perspective for the most part. Disrupt healthcare. And as you do that, the infrastructure software layer is also going to be disrupted. So that's sort of a generic thesis of the fund. We invest a fairly small check, $500K to $1 million at a late stage. That's very, very unusual. Why we do that? In a way, we do that because we can. Writing a small check at an early stage is very risky, right? You have to write a lot of checks to have one success. And generally speaking, when you invest at a late stage, you have to have like those massive funds that have to write mega checks, and you get diluted returns. So we get a bit of the best of both worlds in a way for our investors, where we write a small check at a late stage. And the reason we're invited to do that is because of products that count. Because when we invest in a portfolio company, even though we don't put a lot of money into it, we put a lot of value in it by giving our portfolio access to that really big network of early adopters that they can hire from and they can sell to. So that makes us attractive to a lot of companies who will say, about us, like, this is the best value for the dollar invested, or this is a strategic partner. And that's what we like to be. very often we are invited to a deal. So you asked like the best deal, the deals we like to see. So there's sort of two scenarios where we're brought in. One is a founder has been benefiting from products that count and the network and the community for a long time, and they're now raising Series A or B or C, so they're right there where they need to really accelerate their revenue curve. They're like, how am I going to generate more revenue? Well, I'm going to benefit from the products that count network by selling to those people or hiring those people. So that's a great time for to bring us in as investors, because we're going to help accelerate that. So being brought by the founder is a great situation, or being invited by the founder, or being invited by an investor who knows us and is going to say lead the Series B, just like we did this week. We invested in a company, Series B, and the lead investor said, okay, I'm going to put like a few million in this company, and I'm going to ask Mighty.Capital to come in for a smaller amount, because I know that they're going to help that company of mine be very successful. So best ideal scenario is we're brought in like this, privately, recommended by an investor or identified by a founder. And then when we look at the traction of the company, we see a clear trend in the revenue that's going to lead to profitability within a few years, like a couple of years, and to an exit with a multiple that we like within like 4 or 5 years.
Excellent. So products that count. If you have never heard about this organization, you should, and now you know why. This is just a great extension where so many great products can really go and have multiple sales. So for product managers in the audience, would you mind telling us a little bit more about this largest platform for product managers and what they should have already accomplished in order to get invited, or at least not get invited, but get accepted into the pool?
Mm-hmm. Yeah, absolutely. So everybody is invited. Everybody who's already in product. Products that count is really the mission of the organization is that everyone can build a great product. And for a product manager, somebody who loves to build stuff or try stuff, it's I think it's motivating. That's my background as well. So what we do is we offer online programs. So we have videos, we have podcasts, we have blog posts, we have a weekly newsletter with resources for product managers around the world. And then we have offline programs in a lot of the major tech hubs in the US and a little bit in Europe. And so every month in every one of our cities, we have a speaker series with anywhere from like 100 to 300 attendees. So it's great networking. It's centered around a speaker who's a VP or a C-level in product or growth or marketing, who comes and shares best practices for what it takes to build a great product. And so it's a very I think it's a great way to learn and network and be inspired. And then we also have a series of executive events. So for products or growth VPs or C-level, every couple months or so, there's a program that's more exclusive, that's by invitation and typically like 3 or 4 times over subscribed. So we have a limited number of spots for that.
So thank you so much for this first part of the conversation. I know I exceeded the time limit I was given. Apologies for this. So I will encourage the audience to ask questions, and team has set a protocol for those questions to be asked in a certain way. So if you could do that way, we would really appreciate this.
I'm Arek Talun. We just came to the Valley. We came from Poland. We just came to the Unleash conference in Las Vegas, and now we are riding around here, meeting people. And actually, we are thinking about going global and moving to Bay Area in a couple of months. And we are talking with people like you who are investing in companies on round A and asking for advice. And the one thing that they constantly bring up, and you did as well, is get a lawyer, and and a good one. Yeah, and yeah. So if a part of that, could you give some advice on what are qualities and what are the things that we should look into when looking for one?
When looking for a lawyer?
Yes.
That's a great question. So my recommendation is that you interview several of them and share some specific plans and situations that you'd like them to help you with. And once you have identified maybe like 2 that you think are in your shortlist, then ask them for a reference. Put me in touch with a company who has worked with you, and let's go from there.
Okay, thank you.
Hi. So the first question would be, you mentioned that one of your focus areas is healthcare. And what areas do you see that are, let's say, underserved in healthcare?
So we made an investment a few months ago in a company called Fabric Genomics. They're a genomics data platform. We think that genomics is a massive platform for transformation and revolution, and we may make more investment in that space. So that's one huge area where we see opportunities. We think that there are opportunities as well with the transformation of healthcare from what it is today, which is really meant at treating diseases and like broken legs or pregnancies, like with a beginning and an end, to treating chronic diseases, which is 75% of healthcare costs today, and is not handled properly, right? Like where you have more prevention, more monitoring, than treatment.
So the treatment part or like the prevention part, it's like where is the kind of...
There are opportunities everywhere.
Everywhere, okay. Thanks. Second question was, you mentioned that you also focus on, or that you, let's say, wish to disrupt the enterprise market in terms of sales and marketing functions. Why sales and marketing? What do you see that sales and marketing functions offer for you to disrupt more than, let's say, other functions?
Yeah, so first of all, that's a little bit more our expertise than, back office. So that's where we add more value. Doesn't mean we wouldn't do supply chain investment, but it's sort of where we add more value. Second, if you think of that revolution of connected technology, it's the first one that comes from people. Right? People are the ones who got their mobile phones first. People are the ones who are trying, the Apple Watch and the glasses and all that good stuff. And they're bringing this to work. And generally speaking, that bring your own device, that, adopt into the enterprise, it starts with sales and marketing and sometimes HR. And the reason is marketing is the one that needs to sell to customers, right? Or market to customers. And so they see everybody use their mobile phone. The first thing they're going to do is they're going to start using their mobile phone. And then they're going to go inside their organization. They're going to say, if we don't do more of that stuff, we're going to die, right? So the organization all of a sudden is like, oh yeah, we need to start talking about, digital transformation, mobile transformation. So that's sort of how it comes into the enterprise.
The company. Okay, thank you. And last question, it consists of two questions. It's a question about traction. Basically, why do you think it is, let's say, so difficult for startups to gain traction even when they have an MVP? And what are your, let's say, best ideas how to overcome the traction gap for basically a company selling B2B enterprise software?
So why is it so difficult to get traction? It really depends on the product, but the question you're asking is almost like looking at the problem the engineer way, the way I think engineers, and I'm one, look at a problem versus the sales way. If I have any advice to give, like, look at the problem from the sales perspective. Like, what is it going to take to get value from this customer, or to give value to this customer, as opposed to, here's my product, like, who wants it? Why am I not selling my product? Well, because you built something that nobody wants. And I know it's not you, right? But if you're starting from your customer, you're saying, like, what problems do they have? How am I going to solve it? How am I going to add value? Then you won't have any problem with traction, because you're going to build something they want as opposed to build something you want.
Okay, thank you. Thanks for that.
Sure. I'm Zafar Beg. I have a personalized nutrition company focusing on health and wellness in that space. This question doesn't really apply to me specifically, but I'm curious to know this answer. There's a lot of hype about ICOs these days, right? I mean, everybody's talking about blockchain, even if they don't understand what it is. But companies are even tempted to kind of raise some money through ICO. The amounts are reducing. There is more, criteria to prove themselves, but they're still accessing capital that way. Would you back a company that has raised ICO money?
So the short answer to that is, today we wouldn't. But we're also pretty conservative when it comes to financial risk. We don't really want to take a financial risk. We don't really want to take a technology risk. We take an execution risk. So we would not do an ICO. Now the question for you is, should you do an ICO, or you or entrepreneurs? And the answer to that is, it really depends. Like, it could be very, very good for you if you want to raise a lot of money and you don't care to have smart money, right? So if you're, for example, at a later stage, if you're at an early stage, I really don't recommend it. The reason is sort of similar to what we were talking about earlier, which is, if you get a bunch of money from an investor who's passive, which that's exactly what an ICO is, you're not going to be as successful as if you raise the same amount of money from somebody who's very active, even though that money might be more expensive. But at the early stage, it's important. But then if you're at a much later stage, and you're saying, well, look, I need 100 million, and honestly, like, I can raise it from somebody as passive as Fidelity, or Goldman Sachs, or a sovereign fund, then, like, you might as well do an ICO. It'll be cheaper than to go raise, that expensive money from a, big fund. So I think that ICO, if they're more than a fad, right? There's a scenario where they're just a fad. But if they're not going to be just a fad, then they have a real potential of disrupting one of the trends we're seeing right now in venture capital, which is a venture capital firm raising massive funds, like the SoftBank fund and things like that. You might want to give it a shot if you're later stage.
Okay. A second question about generally the blockchain theme. I'm sure you have seen many companies in that space. Do you think it is a good time for a company to bet on the technology to build their product, or do you think the blockchain is still something that is under development and startups should stay away at a very early stage?
Yeah. So it depends. Different startups play different games. We personally, because we invest later stage, right now we don't make investment in blockchain. If I can draw a parallel, I think we're in the MySpace era of the blockchain, and the successes come in the next era, the Facebook era, right? So we think that the next era of the blockchain will be the one to actually make investments, and this era is about learning, understanding where the opportunities might be. So that's our personal, our fund's perspective. Now, not every fund has this approach, not every entrepreneur has this approach, and in that era, or even in the first era of the Friendster era, some great companies were created more on the infrastructure side, but the risk profile was gigantic, right? Like really high risk, high return, and that's not the game we play. That's not that swinging for the fences. But some entrepreneurs want to do that. Some investors want to do that. So it's sort of, you have to choose your game.
Thank you.
Hi, I'm Chris from Poland as well, and we've been developing a product in the HR tech area, working on intelligence augmentation. And back home, we managed to raise pre-seed, and we're a team of 15 now, and we sell. We got initial revenue, and we set our goals higher. We are in the transition mode to US just now, and there's two parts of our business: the R&D part, and obviously the sales part that we focus on just now. And we feel that we might be looking for a seed round in US, but as you mentioned, the company who comes to US or tries to raise the seed round should have a revenue. And but we at the same time we feel if we don't put emphasis on the R&D part, we'll stay behind the competition in the US market. So what would you recommend to a company like us having quite a high needs for the R&D part and trying to come to US and become a global company?
Yeah. So revenue and profitability are two different things, right? So you can maximize your revenue and still be spending a lot of money on R&D.
Yeah.
It's almost like two separate aspects.
Yeah.
So I would say you can do both.
Well, we're a team of 15 back home, mostly engineers, and it requires quite a lot of money in the AR area, especially data science that we focus on. That burns quite a lot of money, and we feel that we need both to focus on sales and R&D as well at the same time. And if we don't focus on both parts with the same emphasis, we feel that we'll be falling behind.
But I think you can do both. I think you can sell AI for pretty high amounts, and you can grow your team this way. So you're asking, you're sort of going from a zero-sum game where I only have so much money to spend, and therefore, I'm limited in the number of people I can hire, and if I don't do that, then I'm going to have to raise more money. And what I'm saying is raise your price.
What if the competition is cheaper in US than us? And it's okay. We might follow on that later on, maybe. Okay, just thanks
so much. Last question.
My name is Lovrinas. I'm CEO, founder of Harman.ai. We solve data privacy and compliance pains of companies. And my question was, you mentioned several times about smart money. So my question is, what would be the 3 key factors in investors we should look like that define smart money?
That's a great question. So the first thing is what is the value they bring to your company? So I'll give you the example for Mighty.Capital, right? The value is that access to products that count. That's a very, very tangible value, right? The second thing is what is the value they bring to the process of your company. So I mentioned that example of like helping you, like with governance, really helping you at every stage in your board, during your exit, like so helping you manage that process, that life cycle. That's really, really critical. And then you know, the partner who's going to be working with you, is there somebody you want to learn from and work with? What kind of value do you get from that interaction?
Thanks for coming. We'll see you next time.